FAQ Friday, and today's question is one I get all the time from real estate investors. Can cost segregation losses from a new rental property offset capital gains from selling a different rental? Now, the short answer is yes. And for high earners with real estate, this is one of the most powerful tax strategies available when it's structured correctly. So here's how it works. When you buy a rental property, a cost segregation study breaks down the building into its components, the appliances, the flooring, the fixtures, the landscaping, and it reclassifies those into a shorter depreciation categories. Now, with 100% bonus depreciation still in effect for 2025, those components can be fully deducted in year one. Now, we're talking six figures in losses on a single property, sometimes more. Now, those losses are classified as passive losses, and under IRS rules, passive losses can offset passive income, and that includes capital gains from the sale of another rental property. Let me give you a real life example, and I'm changing the details here to protect our client's privacy, but the strategy is exactly what we did. Now, we had a client, a high earning business owner, S Corp, doing very well, about $600,000 in income. Smart person, right? They had been had a real estate portfolio on the side, so they sold one of their rental properties and was looking at about a capital gain of about $115,000. That's a big tax hit. But now here's what we did. In that same year, they had purchased a new rental property, and we had a cost segregation study done on that new property. The study generated about $130K in first year depreciation losses. All of it 100% bonus depreciation. Now, those losses were passive. The capital gain from selling the other rental was also passive, so they offset each other. Now, on top of that, they had about $6,000 in suspended passive losses from prior years that had automatically released when they sold the rental. So that was an additional offset. So instead of paying taxes on $115K capital gain, the gain was essentially eliminated, gone. Now, that's not a loophole, that's structure. That's what happens when tax planning happens before the transaction, not after the deadline arrives. Now, there are some important rules to understand here.